When I first got into investing half a decade ago, the very first thing that I did was look up who the best investors of the last century were. I wanted to see who had the best returns in the stock market over the last 100 years so that I could learn from those people. Because as a national debate champion, I am well aware that there are plenty of people that will say plenty of crap, and it can be hard to know what to believe and what not to believe. Which is why I wanted to go to the very top, to the source, to those who have had the best returns over the last 100 years so that I could learn from those people. Because while even they don't know everything, at least what they do know has proved with a track record that is undisputable that they have a good understanding of how to make money in the stock market. After I figured out who they were, I was like, okay, which ones of these people have written books? And then I read all of their books, and that is how I built my fundamental understanding to invest in stocks, and which is why in just 5 years, I've been able to turn a $20,000 portfolio into an over $500,000 portfolio. And over the last month, I've been putting together all of the information that I have learned from these books. So let's jump into this slideshow that I put together. This is investing for beginners. Honestly, if you're an intermediate, or even if you think you're an expert, you're probably gonna learn something from this as well, because just going over all of this information I found really helpful. And this is all stuff that I already knew and really learned on the first couple of years of my investing journey. So these are simple steps for an average person to become a stock market genius. So if you want to learn how to make money in the stock market, make money by investing, then congratulations, you clicked on the right video. I really believe that this offers more value than a lot of paid courses, honestly, most paid courses. And we're gonna be going over all of this in closer to an hour, but this is, trust me, this is gonna be time well spent. So Peter Lynch and Warren Buffett, Benjamin Graham, these were the first three that my research pointed me to initially. Peter Lynch was the manager of Magellan Fund at Fidelity Investments between 1977 and 1990, and he had an average annual return of nearly 30% over that 13-year period, 30% per year, making it the best performing mutual fund in the world. Obviously, Warren Buffett needs no introduction. He's had an incredible track record as well. So this is really who this information is coming from. It's not coming from me, it's coming from them. So the way that this presentation is going to work is there are literally just two sets of three things. There are three sets of three things, but first we're going to just go over three fundamental truths that I think are just very, very important to internalize and understand as fundamental truths before you get into investing. Then we're going to go over the 3 steps to buying companies that are going to have 5-10x returns for you. And then finally, we're going to go over 3 questions that you might have after watching this presentation. So let's just jump right into it with the 3 fundamental truths and truth number 1. So truth number 1 is that stocks are ownership in real businesses. Now, you might say, duh, of course, that's really dumb. Why does this have to be a truth? But you might be surprised how many of you might be like, wait, stocks are ownership in real businesses? Yes, stocks are ownership in real businesses. So being an investor is often made to look like a job reserved for geniuses. In One Up on Wall Street, I highly, highly recommend reading this book, by the way. Peter Lynch explains how anyone can beat renowned investors by using logic and common sense. It all comes down to putting your money into the companies that you understand. And Peter Lynch has a famous quote that stocks aren't lottery tickets. Behind every stock is a company. Warren Buffett also has a famous quote. As far as I'm concerned, the stock market doesn't exist. It is there only as a reference to see if anybody is offering to do anything foolish. And both of these quotes are making one fundamental main point, which is that stocks and prices, they're secondary. They really don't matter. What matters is the fundamentals of the real businesses, the real companies that you are buying when you purchase a stock. So we have to really internalize that. So to help us internalize that, there is a quick example that I want to go over. This is very, very simple, but I think just giving this example makes the statement, I think, sink in hopefully a lot more. And this is the example of a lemonade stand. So say there was a lemonade stand started with 2 founders, and each founder got 5 shares. So that means that there's 10 shares total. They're owned between these 2 founders. Buying 1 share for $10 would give you 10% ownership and value the company at $100. This is very simple math, but you have to understand this, I think, to understand when you start buying bigger companies. So if you're buying 1 share for $10, remember there's 10 shares total, then 1 of 10 shares means that you have 10% ownership in this lemonade stand. And if you're paying $10 for just 1 share and there's 10 shares total, that means the total value of the company with all 10 shares is $100 if all 10 shares are worth $10 each. So this is very, very, very basic stuff. But I think that there are literally hedge fund managers, there are people in Wall Street on TV that I think don't even understand this simple basics here, that a stock is not a lottery ticket. A stock is an actual percentage ownership in a real business that is functioning in the real world. So now we're going to take this example to the level of the actual stock market and look at something far more complex, but don't let this overwhelm you because we're just going over the same exact basics that we just went over, but with an actual company. So example number 2 here is Tesla. The number of shares outstanding as of August 2023 in Tesla is 3.17 billion shares. So a lot more than 10, but it's the same thing. It's just one company and it's now divided 3.17 billion ways instead of being divided 10 ways. So Elon Musk, who's the CEO and co-founder of Tesla, has 411 million shares. Honestly, of all of the big cap, like top 100 companies in the S&P 500, Elon Musk is a founder and CEO who has more actual ownership of the company than any other CEO running any top 500 company, which is honestly really impressive. And I like how that aligns incentives because he's an actual owner. But let's do this math here. So 411 million divided by 3.17 billion equals 0.129. You can run the math yourself. I did this in a calculator. It is accurate. So that means that Elon Musk owns almost 13% of Tesla. He owns 12.9% of Tesla. So that means that if we went back to the lemonade stand, if Tesla was that lemonade stand, Elon Musk would own 1.3 shares or 1.29 shares of the 10 shares of that lemonade stand. Makes him a relatively large owner. And he is the biggest single individual owner of Tesla. But I also am a shareholder of Tesla. I actually own a little over 2,000 shares as the biggest position in my personal portfolio. So we can do the same exact math that we just did to find out that Elon owns 13% of Tesla. We can divide my 2,000 shares by the 3.17 billion shares, and we find out that my ownership of Tesla is 0.0000063, or 0.00006% of Tesla. Obviously, that is a very, very small percentage ownership, but we're doing this because we're trying to just like really get into your guys' heads. This is so important as a fundamental truth before we move into all of the other stuff about how to make money. You have to understand this. My 2,000 shares of Tesla are a real percentage ownership of the business. So that percentage means that if Tesla reaches its goal of producing 20 million cars a year, which it wants to do by 2030, maybe it takes them till 2035, who knows? Elon is obviously normally very optimistic, but I think they will hit 20 million cars annually eventually. They've proven that they can execute and do eventually hit their goals. Once they're reaching 20 million cars a year, my percentage ownership here means that my share of the company will be selling 12.6 cars per year, which is really, really cool because selling 12 Teslas a year is definitely something that I could live off of. So I feel like my 2,000 shares, being able to sell 12 Teslas a year once they're at 20 million, that is really cool and is going to be enough revenue and profit off of those 12 cars that I think that that's something that I could literally just live off of, that 2,000 shares looking into the future. But that's not what's important. The main thing that's important here is that I own an actual stake of Tesla and I have an actual number of cars sold per year. That's my share of cars sold. So also we can find out the valuation. So right now Tesla's going for like $250 per share. It's going to be different when you're watching this, I'm sure. But $250 per share times 3.17 billion total shares means that Tesla is currently valued at around an $800 billion valuation. Meaning if you add 200 billion more to the valuation, they would be a $1 trillion company. And that hopefully helps just really put this truth one into your mind, that stocks are an ownership in a real business. And it doesn't matter that we're at 3.1 billion shares. It's like, to find out the value of a company, we're multiplying the dollar per share times the total number of shares. That's the value of the company. And we can find out our own percentage ownership of the company and stuff like that. Okay. So now let's move to truth number 2. This is that temperament matters more than intelligence. And I really want this truth to sink in as well. Temperament matters more than intelligence. And to help get this truth to sink in, I have a lot of quotes here from very famous investors, my heroes who have done incredibly well in the stock market. So this first quote: all the math you need in the stock market, you get in the 4th grade. Peter Lynch. So just know, if you're not a math whiz, if you're not a 140 IQ individual, if you don't understand like calculus and even higher levels of algebra, even any algebra, honestly, it doesn't matter. You just need to know how to add and subtract and divide. That's it. All of the math that you need in the stock market, you get in the 4th grade. So keep that in mind. Intelligence is not the main important skill for the stock market, which unfortunately I think a lot of people on Wall Street don't understand, which is why they like to overcomplicate very simple things. Now let's look at a quote from Warren Buffett. The good news I can tell you is that to be a great investor, you don't have to have a terrific IQ. If you've got a 160 IQ, sell 30 points to somebody else because you won't need it in investing. There's Warren Buffett, selling points of IQ. What you do need is the right temperament. You need to be able to detach yourself from the views of others or the opinions of others. And guys, this sounds simple, but it is very, very difficult. There have been tests done, like social experiments, where people are put into a room and asked simple questions with very obvious answers, like 2 + 2 type stuff. What is 2 + 2? And if you're around in a group where 5 of your peers all answer something else very convincingly, they sound very confident, and they're all in agreement about the wrong answer, the 6th person oftentimes, the majority of the time, even if they know that the other 5 people said something wrong, they will just throw in their ticket with the 5 people that went before them and say, yeah, that's the truth, because they don't want to seem weird. They assume that they're missing something, even when the answer is very obvious. And this is so bad in the stock market. You have to be able to do the analysis yourself, come up with understandings yourself. It's not that complicated, guys. None of it is actually that complicated. And don't let the fact that someone is smarter than you obviously make you start second guessing your ideas and opinions. Now, you should listen to their reasoning. If their reasoning actually makes sense from a fundamental level, then that can impact your own viewpoints. But you have to be able to detach yourself from the views of others and the opinions of others and just make decisions based on the facts. And you can't second guess the facts. All right, next quote. This one from Howard Marks. The most important quality for an investor is temperament, not intellect. Just kind of seconding what Peter Lynch and Warren Buffett have already said. So now one more Warren Buffett and Peter Lynch quote. The business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective. Warren Buffett. So honestly, some of you guys that might come from a college educated background where you've learned stuff about modern portfolio management and stuff, you are probably at a disadvantage. Sorry, but it's the truth. You're probably at a disadvantage over someone who's watching this, who has no prior stock market experience, who hasn't been indoctrinated with false complexities that are going to confuse them and overcomplicate things and cause them to miss the forest through the trees, the simple facts that really help you to make good investment decisions. So if you're coming from this with no prior experience, you're at an advantage. And that's why I really wanted to make sure that when I started getting into investing, I started my learning from those who had proved the most successful instead of those who have the highest degrees and the biggest titles. No, who's actually performed, because they're the ones who actually understand what matters. And Warren Buffett will tell you that complex behavior it's rewarded in business school, but simple behavior is what is more effective. All right, then the final quote here on this page is, in the stock market, the most important organ is the stomach. It is not the brain. It's not the brain, Peter Lynch. And when we get into this third truth, the reason for this is going to start becoming more apparent. So, first truth, stocks are ownership in real businesses. Second truth, temperament matters more than intelligence. Honestly, if you're taking notes, two very simple things to write down that are very, very important. Okay, so let's look at the examples to this. What do you do when your friends are all making money doing silly things? So this is getting into the temperament over intelligence thing. The dot-com bubble is a great example. During the dot-com bubble, there were IPOs every single week that were doubling, tripling, quadrupling the moment that they went public. So you may have been working somewhere. I think this is actually a story that comes from a true story. You may have been working somewhere and you had a friend say, hey, my broker told me to get in on this IPO of this cool company. Insert name here, XYZ company. And he says it's going to double. He says it's going to double on day one. And you might be like asking your friend, well, that's kind of interesting. What does that company do? And your friend might respond, I have no idea, man, but it's going to make me a lot of money. And obviously, as an intelligent person, or at least someone with common sense, you might sit there and be like, well, that sounds really stupid. You're buying into a company that you don't even know what they do because you say it's going to double. Like, that doesn't make any sense. And then guess what? Next week, he comes back in. It's Monday. He's like, guess what? The stock went public and it didn't double. It tripled. And I just tripled my money. And you're like, wow, congrats, man. You must have got really lucky. And then the next day, he comes in and he's like, yo, my broker told me about this new stock. It's like a similar thing. It's another tech company. He says this one's going to double too. And you're like, oh, wow, that's interesting. What does this one do? I have no idea, man. Who cares? It's going to double. It's going to double, bro. Who cares? And the next day he comes in. He's like, bro, this one quadrupled, man. It quadrupled. I quadrupled my money. And you're going to be sitting there and you're going to start feeling a little bit stupid. Like, yo, my friend who's an idiot is making all this money on these IPOs. Why am I not participating if it's like this easy and someone so stupid can do it? And you're going to start to second guess silly things. And you're going to start thinking that maybe silly things are a way to make money. And you might consider participating, especially when there's a third one and he does it again. But the thing is, all bubbles eventually crash, and especially stupid things, they have a limit on how long they're going to work before it's just all going to come crashing down. Okay. So what do you do when your friends are all making money doing silly things? It's a hard one, man. That is a hard one. But temperament matters more than intelligence, and not getting caught up in these bubbles. Because guess what? Your friend is probably going to be like, man, these went up so much, I'm just not even going to sell it. I'm going to hold it. And then he's going to hold the next one and the next one. And he's going to feel super rich. And then when the bubble collapses, he's going to lose everything. And you, by being the person who jumped in right at the end, you might not even get any of the upside and just lose everything, you know? So fundamentals matter. And things that seem silly probably are silly. Now, that said, the stock market can stay irrational for long periods of time. Okay, second question. What do you do when the market keeps selling something that you think is undervalued? So this is the opposite side. Let's say that you've done the fundamental research on a business, and we're going to get into how to do all of that later on, don't worry. And something just keeps on going down, and you're like, this is worth so much more than the market is selling it for. It's worth so much more than I bought it for, but now it's worth even less than I bought it for. What do I do? And this is where temperament matters more than intelligence. So I'm going to read a story here now from Peter Lynch that he shares in his book, One Up on Wall Street. In 1972, shares of Taco Bell were going through a major correction. But legendary investor Peter Lynch saw an opportunity. In just a short time, the stock price had been cut in half, from $14 per share to $7, despite no obvious issues with the business. And this is the linchpin here. If the business isn't suffering, but the stock price is suffering, that is oftentimes opportunity. Lynch began scooping up shares, but the correction wasn't over. Shares kept sinking, eventually hitting $1, an 85% pullback from the $7 level where Lynch started buying the stock. What would you do if that was you in that situation? What would you do if you had seen something drop from $14 to $7 and you're like, wow, the business fundamentals are staying super strong. This has to be an opportunity. And after you bought at $7, it fell to $6. And then it fell to $5. Then it fell to $4. Then it fell to $3. Now you've lost over half of your investment. But the fundamentals, they keep reporting and they're still strong. You go to Taco Bell and you're like, hey, people are still here eating. What's happening? What are you going to do? The fundamentals, the intelligence isn't what matters here. It's your stomach. That is what really matters. Can you stay in the game? But rather than chalking it up as a loss, so going back to the Peter Lynch story, an 85% pullback, yeah, eventually hitting $1, an 85% pullback. But rather than chalk it up as a loss, Lynch kept buying Taco Bell. You see, Lynch knew the real story. The company had no debt and continued to see strong growth, which meant the pullback in the stock's price was a great opportunity for patient investors. Now you might have felt like you lost everything. What is going on? But it was an opportunity. And as we now know, Lynch was absolutely right. Once the dust, and so now you might ask the question, wait, how was he still so confident? How was he still so confident when the stock kept falling? And the secret is in this line here. The company had no debt and he continued to see strong growth. The fundamentals are what gave him the stomach. He knew why he bought it. And he knew that when the price was falling, it wasn't for the reason, it wasn't disproving the reason that he bought it. Once the dust settled, Taco Bell was acquired by PepsiCo for $42 per share, making it a five-bagger from 7, 14, 21, 28. Honestly, more, 28, 40, yeah. Five-bagger from the original price. Meanwhile, remember, math doesn't matter. The general thing is what matters. Meanwhile, a stock going from 1 to 42 is a 42 bagger or 4,100% gain from $1. So as the stock fell, the opportunity got bigger. It didn't disprove Peter Lynch's original point. It should have grown his conviction. What? $3? This is crazy. $2? This is crazy. $1? This is the opportunity of a lifetime. And it really was, going then from $1 to getting acquired by PepsiCo for $42 per share. So, truth number 2, temperament matters more than intelligence. Because guess what? What do you think your friend was telling you at work the whole time? Because you probably told him, hey, I started buying Taco Bell at $7 because it fell from 14. I think this is a great idea. And at $5, he's probably laughing at you. Bro, you're losing so much money. You're so stupid. And he doesn't know anything about the fundamentals. And then at $3, at $2, at $1, he's like, bro, it's going to zero. It's going to zero. You're going to lose everything. And if you don't understand the reason you bought the stock, if you can't see those fundamentals continue to grow with strong growth, then you might change your mind. You might be like, man, maybe I was wrong, because you don't know what actually matters. The stock price does not matter. The fundamentals are what matters, which is why we have this Warren Buffett quote here. As far as I'm concerned, the stock market doesn't exist. It is there only as a reference to see if anybody's offering to do anything foolish. Warren Buffett. This is how you should view stock prices. They don't matter unless someone is offering you a crazy opportunity to sell way overvalued or to buy way undervalued. What matters are the fundamentals of the company. Okay. Truth 3. After this third truth, we're going to get into the steps that are going to show you how to actually make a lot of money in the stock market. But this third truth, there are these fundamental layers that the steps that you have to take. Like if you're walking on sand, you're not going to walk very far and you're going to keep tripping and falling. But if we build these truths, if we build the concrete foundation that you're walking on, then the steps are going to be much easier to follow and it's going to be a lot easier to make a lot of money in the stock market. So this third truth is very important. Markets go down. Let that sink in. Markets go down. Okay. There's a number of quotes I want to read here. This first one from Peter Lynch. Some have fancied themselves long-term investors, but only until the next big drop or tiny gain, at which point they quickly become short-term investors and sell out for huge losses or the occasional minuscule profit. It's easy to panic in this volatile business, and I don't think truer words have ever been said. It's easy to panic in this volatile business. Your stomach matters more than your mind here. And this selling for a tiny gain thing, I have seen it over and over and over and over again. When I was buying Tesla in the COVID drop, when it fell to $300, this is pre-split. Now it's thousands and thousands of dollars if you don't count the stock splits. It is 20x'd from that price. I saw so many investors selling out. It's up 20%, I'm selling. It's up 50%, I'm selling. It's doubled, I'm selling. It's tripled, I'm selling. If you sold when it tripled, you missed a 5x after that. So it's important to understand the fundamentals, because sometimes stock prices go up a lot, but if fundamentals are also going up a lot and have so much more to go, then it's not a good idea to sell for a small profit. The key to success in investing, this is now Howard Marks, is not to get scared out of your positions. That's such a simple quote, but so true. The key to success in investing is not to get scared out of your positions. Now, I do want to make a quick note here. If the fundamentals of your company are going down, like the profit has started plummeting, the revenue has started plummeting, and the actual fundamentals, the company just isn't earning revenue, people don't want to buy their products, that is different than a stock price going down. A stock price going down when fundamentals stay strong don't matter. However, if the actual fundamentals of a company are deteriorating, and you don't think that those are going to turn around, then you should get out, because the fundamentals, remember, are what matters. And sometimes you'll have fundamentals start to deteriorate and the stock price will keep going up. That's wonderful for an awesome opportunity for you to sell out. If you see the fundamentals going down and the stock price is still going up, then you can sell out at a great price, and it's wonderful. But the important thing to remember here is, what is scaring you out of your position? Don't let it be the stock price. Don't let it be the market. If something is selling you out of your position or causing you to get scared out of your position, it should be the fundamentals, the actual company not achieving the goals that they've promised, failing to meet the expectations that they've set or that you believe that they were going to hit. That is what matters. Fundamentals, not stock price. Okay. Next, from Peter Lynch, we have a quote. Obviously, you don't have to be able to predict the stock market to make money in stocks, or else I wouldn't have made any money. I don't believe in predicting markets. I believe in buying great companies, especially companies that are undervalued and or underappreciated. Pick the right stocks and the market will take care of itself. Peter Lynch. So there's a number of really important things in this. First of all, you can't predict the stock market. The stock market is a manic depressive individual. Warren Buffett describes the stock market as your crazy neighbor who sits at your fence every morning and screams random prices that he's willing to pay for your house. It doesn't matter what price he's screaming that he's willing to pay for your house. You know what your house is worth to you. And the only time it matters is if he's screaming a super undervalued price that he's willing to sell his house for, then you might want to buy it. Or if he's screaming a super overvalued price that he's willing to buy your house for, and you're like, well, that's a lot more than my house is actually worth. I guess I'll sell it to him because I can buy something else somewhere else. Those are the only times it matters. But the stock market is not the arbiter of truth. It is the crazy, manic, depressive neighbor. And it's important to understand that. And because of that, you can understand when a company's undervalued. You cannot predict when the market is going to start pricing that company at the right price. Does that make sense? You can understand when a company is undervalued. You cannot predict when the market is going to start giving that company a fair value. Two completely different things. So we have to make our decisions based on the facts of today. We cannot make our decisions based off of predictions of the future. I think it's Howard Marks who said there's only two types of analysts in the world. There are those who predict the future. There are those who don't know, and there are those who don't know that they don't know. But all analysts don't know the future. And obviously, if you have 100 people predicting what's going to happen, one of them is probably going to be right. But they're not going to be right over and over again because it's impossible to consistently predict what the manic depressive stock market is going to decide things are worth going forward based off of what fears or greed the market's sentiment is pricing things based off of. So that's why Peter Lynch says, I don't believe in predicting markets. I believe in buying great companies, especially companies that are undervalued or underappreciated. And this also means that you can buy an undervalued company and it can keep going down because markets go down. And you need to have the stomach to understand that doesn't matter and that that's an opportunity to buy more if fundamentals stay strong. All right, the last quote for this slide here. In certain years, you'll make your 30%, but there will be other years when you'll only make 2%, or perhaps you'll lose 20%. That's just part of the schedule of things, and you have to accept it. The market, like individual stocks, can move in the opposite direction of the fundamentals over the short term. Peter Lynch, and I think this is the most important thing here. The market can move in the opposite direction of fundamentals over the short term. You just need to understand that and you need to accept that. But if you own a great business, down markets are an opportunity to buy more of that great business. So We now have our foundation laid. We understand the three super important truths that we need to just really get concrete in our heads. Stocks are ownership in real businesses. Temperament matters more than intelligence. And markets go down. All right. Are you guys ready for the 3 steps now to making a ton of money? You guys want to get rich in the stock market? All right, well, keep listening. Also, if you guys are enjoying this, remember to drop a big thumbs up on this video. I really appreciate it. I spent a long time preparing this, and even longer if you count all of the years of research and reading books and stuff. And then also, if you're not subscribed yet, make sure you guys are hitting subscribe, because this is going to be a great channel to at least get ideas for you to start researching from. I definitely don't recommend buying and selling specific stocks based off of the ones I talk about, but they are great places to find ideas and opportunities. So make sure you're subscribing for future videos. Okay. But an example for markets going down. On average, and this is important to know, this is just really going to make it concrete in your mind that markets do go down. On average, the S&P 500, and if you don't know what the S&P 500 is, it is just an index of the 500 biggest profitable companies in the United States. If a company falls out of the S&P 500, it's replaced by the next one that took its spot. So it's literally just the biggest companies in the US that are profitable. The S&P 500 has experienced a correction once every 2 years. A correction just means a 10% drop. A bear market once every 7 years. So that's a 20% plus drop, and a crash once every 12 years, which is a 30% plus drop. So on average, over its lifetime, this is what has happened. This means that in a 14-year period, you'll have 6 10% pullbacks, 2 20% pullbacks, and at least 1 30% pullback on average. That's 9 times the market will fall within a 14-year period. So there are a lot of pullbacks in the stock market. 9 times in 14 years, that's almost every single year. The market is going to come down to some extent. That is normal. You need to understand it is normal. This also really, and I can't pound this into your mind enough because I've had to pound it into my own mind. This is a great truth to have in the back of your mind to help you fight FOMO, which is fear of missing out. When a stock keeps running up that you like and you're like, oh, it just keeps getting more and more and more and more expensive. I'm never going to be able to buy it. Pullbacks always happen. So when it's running up a lot, it seems like it's just going to keep running up forever. It will not. I promise. Okay. That said, sometimes if something is super mispriced, it gets repriced and then the pullback happens and it never gets back to when it was super mispriced again. But pullbacks do happen. Yet despite this, the S&P 500 has gone up around 8% per year on average over its lifetime. And then Howard Marks, I believe, at least I read this in his book, has a great quote. Don't forget the tale of the 6-foot-tall man who drowned crossing a river that was 5 feet deep on average. So averages, even though the S&P goes up 8% per year on average, don't bank that it's going to go up 8% this year, because it's not. It never goes up 8%. It always goes up 20% or pulls back 10%. It's manic depressive. So on average, yeah, it goes up 8%, but don't forget the tale of the 6-foot-tall man who drowned crossing the 5-foot-deep river on average. Individual stocks will often fall far more than the entire index. This is also important. If the whole S&P 500 is dropping 30%, you better believe there's going to be stocks in that market that drop 90%. Okay? The big index is going to be less volatile than individual stocks in that index. So even when a market pulls back 10% or 30%, there's going to be some stocks that actually go up, but there's going to be some that go down a ton more than the index. So the market can stay irrational longer than you can stay solvent. Okay, we got these 3 truths down. Let's look at, finally, step number 1. So step 1, research businesses. Guys, if this sounds simple, it's because, remember the quote, it's not complex, guys. It is simple. Making money in the stock market is simple. Research businesses. So many people don't do this. And then they have no conviction to buy more when stocks go down. They have no idea what's going on or why. You have to research businesses. All right, Warren Buffett says, never invest in a business you cannot understand. And Warren Buffett will be the first person to admit he has missed tons of opportunities. He has missed so many opportunities. One being Tesla. I think he super missed Tesla. It was super undervalued, especially in like 2019, early 2020. Super undervalued. He didn't buy it. But that's because he never invests in a business that he cannot understand. And because of that, guess what? He's not going to get scared when things crash. If you buy a business you don't understand, you are not going to have the stomach to keep holding when the stock price crashes because you don't understand what the business does. Never invest in a business you cannot understand. Next quote from Peter Lynch. No wonder people make money in the real estate market and lose money in the stock market. They spend months choosing their houses and minutes choosing their stocks. In fact, they spend more time shopping for a good microwave oven than shopping for a good investment. Investing without research is like playing stud poker and never looking at the cards. Trust me, you're not going to win very many poker hands when you're betting and gambling and you don't know what your cards are. You have to understand the fundamentals of the businesses that you're looking at. And we're going to go more into that a little bit later, how to research business fundamentals, how to know if something's undervalued or not. Don't worry, that's all covered in this video. But this is just the important thing. Step one before you buy any stock is research the business and understand the business. All right, last quote here. If a business does well, the stock eventually follows. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. Warren Buffett. Okay, if the business does well, the stock market eventually, and this is a big eventually, the stock market eventually follows. I don't know how long it's going to take. No one knows how long it's going to take. No one can predict when it's going to follow. But if a business does well, the stock always follows eventually. It always follows eventually. So when you buy a stock, you should be perfectly happy if you couldn't sell it for 10 years because the stock market completely shut down. That should not matter to you because a good business is going to keep performing. And when that stock market opens back up, that stock is going to skyrocket. So step one, research businesses. We'll get more into how to do that in a minute. So I now have an example that I want to play for you guys. So give me 1 second and I am going to pull this up. So this video clip that we're about to watch, it shows you the importance of understanding the fundamentals. So doing your research and really understanding the fundamentals of the business that you own. And it's also going to help you understand how to deal with a falling stock. This is a speech that Peter Lynch gave back in 1994.
Kaiser Industries had gone from $26 a share to $16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now fortunately this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. I was able to, it was compressed. And at 3, I figured out, there's something very wrong here because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt.
Okay. I'm pausing it here because I just really want to make sure you guys heard that. Kaiser Industries is a company that he did fundamental research of, and he said it is worth a certain amount of money. So when it fell, he's like, oh my gosh, it's worth more than the stock price is selling for right now. Because if you add up all these businesses that Kaiser Industry owns, you add them all together, the value of the company is worth more than the current market. The manic depressive neighbor is screaming at you that he's willing to sell the stock for. So he started buying it. And then guess what? The next day, the neighbor said, I'll buy this, I'll pay this well. And then the gap just started growing and growing and growing. And every single day, the stock was falling. And if you didn't do your fundamental research, you would probably panic. But he, right here, Peter Lynch, is making it very clear. He understood. The company had no debt. The company owned this percentage of this company, this percentage of that company, that percentage of this company, this percentage of Jeep. So obviously it's worth more than this. This is crazy.
Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel. They sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? Psychiatrists haven't worked so far. I've never seen them running in this.
Okay. We're gonna end it there. But did you hear that? What they ended up doing is they just distributed all of the shares of the companies they owned to the shareholders, and it was worth $50 per share. You got $50 per share. So he was like, oh yeah, obviously when I bought it at 16, it was too early. Well, was it too early? I mean, I guess Mr. Market might say that it was too early, but in reality, it wasn't too early. It was worth $50. You were buying it at 16. What would you do when it went to 8? Buy more. It's worth $50 if you add up all the companies. And that is why it is so important that you do the research, guys, that you understand the businesses that you're buying. All right. Step 2. So step 1 was do your research, and we'll get more into how to do research and stuff. Don't worry. We're going to get into how to value companies and stuff. But step 2, just getting over these next 3 fundamental things. So we went over the fundamental pillars, right? Your foundation. Now these are the steps. So step 1, research companies. Step 2, buy companies you understand. Buy companies you understand. And then this is the caveat. This is important. At fair prices. Buy companies you understand at fair prices. So we got some more quotes here to read to kind of bring this point home. For the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. Warren Buffett. Now, Warren Buffett is someone who wants to buy and hold forever. So he would probably still make money because he would hold for over the decade and then he'd start making money after that. But this is an important thing to keep in mind. An excellent company, if you pay too much for it, can undo the effects of a subsequent decade of favorable business developments. So I don't want to point out, I'm not going to name any specific companies here, but there's been times in history where you had like 50 stocks, was it called the Fab 50 or something like that, where everyone's like, these are the best 50 companies to own, and they always go up and they're always growing. But they got so overvalued that at a certain point you would buy those and you just couldn't make money on them because it didn't matter that they were excellent companies. They were too expensive. And that meant that the next decade of growth, it was already priced in. So the stock's going to do nothing for the next decade because it's already so expensive. So buying excellent companies is important, but paying fair prices is also important. And the only way you know the fair price is not by listening to what Mr. Market is saying a company's worth. That does not tell you anything. Unless, well, it tells you if they're willing to pay way too much or way too little, but it doesn't tell you anything. What tells you everything is looking at the company's fundamentals, coming up with a fair value calculation yourself, and then the market price matters as, okay, they're charging way too much or they're charging way too little, but it does not tell you anything about the fair price, the fair value of the company. Howard Marks says, investor psychology can cause a security to be priced just about anywhere in the short run. You hear that? Investor psychology can cause a security to be priced just about anywhere in the short term. And guys, that is opportunity right there. That is opportunity. So many excellent companies sometimes are priced at ridiculous prices, regardless of its fundamentals. Establishing a healthy relationship between fundamentals, value, and the price is at the core of successful investing. So establishing a healthy relationship between fundamentals or value and price is at the core of successful investing. So they are two very distinct things, guys. Fundamentals, value, and price are completely distinct things, and understanding the difference and the relationship is at the core of successful investing, Howard Marks says. Investing is a popularity contest. And the most dangerous thing is to buy something at the peak of its popularity. The safest and most potentially profitable thing is to buy something when no one likes it. Howard Marks. And guys, that is why psychology is so important, and intelligence isn't what matters. It's your stomach that matters. Because when no one else likes something, it is very hard to be the only person that likes it. Trust me. It's very hard to buy things at the very bottom. It's impossible to know the very bottom, but you can know when things are super undervalued compared to fundamentals. And the most profitable thing is to buy something when no one likes it. So if there's a stock that everyone is talking positively about, it probably has a lot of future growth already priced in, and it's probably a little bit overvalued, at least a little bit, compared to the current fundamentals. All right, and then the final quote here before we get to the example. The best time to buy stocks will always be the day you've convinced yourself you've found solid merchandise at a good price. The same as at the department store. So I love Peter Lynch. He tries to make things always so simple because they are so simple. When do you buy a stock? When you found a solid merchandise at a good price. Those are the only two factors that matter. Solid merchandise, good price. That's it. It's simple. It's so simple. Okay. What are the three indicators of a good deal? So how do you understand the good price? This is the example for this. So it's going to get a little bit more complex here just for a moment. But trust me, guys, this is like the most complex thing you need to understand here. Okay. So if this doesn't overwhelm you, nothing in stock market investing will overwhelm you. I promise. So we have PB, PE, PS. Oh, so scary. Okay. Price to book. So these are the indicators of fundamentals. This is the price that you're paying compared to the value of assets. And there's a ratio here called PB. So price of a company compared to the value of all the company's assets. That could be property value, could be cash value, could be licenses, etc., minus all of the debt. So just to make it very simple, if we use the example of the lemonade stand, say the table that the lemonade stand is used for, the land, the little lot that the lemonade stand is on is valued, the cash that the company has, say all of that is worth $100. Okay. So it's not a very valuable piece of land. It's just a tiny little couple foot little segment of dirt. And then you have a table that's worth like 15, 20 bucks. You have some lemonade and you have like 20 bucks of cash. And all of that together is worth $100. So if we go back to our original example where the lemonade stand was owned by just like the two founders. Remember this right here? There's two founders, 5 shares each, so 10 shares total. Each share is $100. If the share is selling for $10 and there's 10 shares, so the company's valued at $100, and the company's book value, which is the value of their little piece of land, maybe they're just renting it, their table, the lemons that they currently own, the little pitcher that they have, the cups that they have, the 20 bucks of cash that they have, you add all that up, that's also worth $100, then your price to book is 1 because it cost $100. That's the value of the company. And the assets that the company has, let's say it has no debt. They didn't borrow any money to buy the table or anything. The assets that the company has are worth $1. The value of the company is worth $100. The value of the company is $100. So the price to book ratio for this lemonade stand would be 1. It would be a price to book of 1. It's not actually that complicated, guys. You're just looking at the values of the company or the price of the company and the value that that puts the company at, and then the value of all of the assets that the company owns. So price to book is the ratio between the price that you're paying for the company and the book value of the company. So we're going to look at some examples of this, I believe in the next slide. But let me quickly go over the next one. Hopefully that makes sense. If it doesn't make sense, leave a comment. I can do a whole video on this, but it should be very simple. If Tesla is worth $800 billion and all of their factories together are worth $800 billion, then it would have a price to book of 1. But say that all of the factories, all of the licenses, all of the cash that Tesla has, say it's only worth $100 billion and the stock's selling for $800 billion, then the price to book would be 8. The book value or the price is 8 times greater than the book value. Does that make sense? Hopefully that makes sense. Very, very simple. Price to earnings. Also, you could think of it as price to profit. So first, let me say, so price to earnings and price to sales, the difference between sales and earnings are total revenue. So that's your sales, your total revenue. So if a company brings in $100 million, that is the total revenue. But let's say that all the expenses, paying for the employees, paying for rent, paying for the cost of goods sold, say all that is $700 million. So the whole revenue is $100 million. That's the revenue. The expenses are $70 million. Sorry, not 700. The expenses are $70 million. So revenue, $100 million. Expenses, $70 million. The profit is then what falls to the bottom. After you minus out the expenses, so $100 million gets minused out, $70 million gets minused out, that's the cost of it. Then you have $30 million left. So $30 million would be your earnings or your profit. Hopefully that makes sense. So your earnings are what's left over after all of the expenses have been taken out. And you have to be careful because a lot of companies like to do stuff like EBITDA, which is EBIT. It's like earnings before taxes, interest, depreciation, and amortization. It's just like hogwash, I think, is what Warren Buffett's partner likes to call it. Earnings is what's left over after everything else. Companies will like to say that they have EBITDA earnings, which is like earnings if you don't count the taxes and all the other expenses, but like those are actual expenses. Okay. So as an owner, you don't get that money. It has to go to the government, or it has to go to depreciation. It has to go to other things. But this is very simple. So if a company has, going back to that example, if a company has 100 million of revenue, 70 million of expenses, so 30 million of profit, and the company sells for $100 million, then you can multiply. So 3, 6, 9, it's about a 3 point something price to earnings ratio, which is actually super cheap. If you could buy a company for just 3 times earnings, that is very cheap. Most companies, I think the S&P 500 averages like 15 to 20 times earnings. So the average company that's in the S&P 500, you're paying 15 to 20 years worth of earnings to buy the company, which means that if you held that company for 15 years and you paid 15 times earnings, it would take 15 years of earnings before you got all the money back that you paid for the company. After that, all the profit after that is just profit because you already got all your money back because it's been 15 years of earnings. 20 years of earnings, same thing. It's just 20 years of earnings it would take before you got all the money back out that you paid for the company. So if it was selling for $100 million and its revenue was $100 million, the price to sales would be 1. because you're paying 1 year's worth of revenue, 1 year's worth of sales. So it could have a price to earnings of 3 point something and a price to sales of 1, because sales is the top line, earnings is the bottom line. Hopefully that makes sense. If it doesn't, just listen to this one more time, and it should really sink in for you, and it should make sense. So price to earnings is how much you are paying for each dollar of earnings. Price to sales is how much you are paying for each dollar of revenue. Pretty simple. Warren Buffett says price is what you pay. Value is what you get. These indicators help you to understand the value that you're getting for the price. So these are 3 indicators that can show you whether or not you're paying too much or getting a good deal. Okay, so let's look at some examples. If you didn't understand that, hopefully these examples will help you to understand better. So Peter Lynch, by the way, he had a fair value calculation that assumed that when a stock is fairly valued, the trailing PE, which meant the previous 12 months of earnings, would equal its long-term earnings per share growth rate. So he would say if a company is growing 30% per year, if they're growing their earnings 30% per year, then fair value for a company would be 30 times last year's earnings. Just a simple calculation that he had that kind of just helped him simplify whether or not he was paying too much or too little. So Tesla, for example, I think you're paying like 50 times earnings, but they're growing 50% a year. So he might say, oh, Tesla's fair valued because you're paying 50 times earnings, which is a lot. That's 50 years of earnings, but it's growing 50% a year. So it's worth that extra premium because it's growing so fast. Okay, so we're going to look at 2 examples here, Coca-Cola and Roku. So let's start by looking at Coca-Cola here. So price to book. So remember, this is the very first thing, price to book ratio. This is a cool website, Macro Trends. We're going to try to make our own website on this channel that you guys can use eventually, but right now we don't have one. So macrotrends.net is one I recommend. So Macro Trends has a lot of just like long-term, you can just look at like overall, like here, let's just look at Coca-Cola's revenue. This is just Coca-Cola's revenue from 2009 to today. So you can see that their revenue was 30 billion in 2009. It is 44 billion today, but it actually rose a ton. Look at this. It had insane growth for a while. I actually don't know enough about Coke to know what caused this, but that was crazy revenue growth. And then it actually fell quite a bit, and now it's risen back up. So their revenue, honestly, it's kind of hard to see what's going on here. It looks kind of flat, to be completely honest. But over the last year, it has been growing. So that's not what we were looking at, though. We're looking at price ratios. So starting off, they have price to book ratios. So you can actually look at the historical price to book ratios. So the current price to book ratio for Coca-Cola is 9.51. So that means that if the book value of Coke was $100, you would be paying $951 to buy the stock. Remember, this is just one of 3 ratios that we can look at here. But if you actually look historically, it normally trades, or it has traded for a lot cheaper than this. From the 2009, 2010, 2011, 2012, like the highest it was trading for to 2013 was 3.78 times book value. Now it's just continued to go up. So this is multiple expansion is what we call it. So when fundamentals are not really growing that much, remember, actually the book value of Coke was a lot higher. They may have took on debt, which brought the book value down because you have to minus the debt. Or a number of factors could bring down the book value per share. But now you're paying almost 10 times book value. This is where it's been for the last couple of years. You're paying 10 times book value. And there's been times in the past where you only had to pay 3 times book value. 369, that's 3 times more that you're paying now for Coke on a book value ratio basis than you used to. So that's just one thing that we can look at. We can also look at price to sales. So remember, that was the second thing here. Or sorry, price to earnings is the second thing. We'll look at that second then, sure. So price to earnings. So this has not gone up as much, but it is still up quite a bit. 2009, you were paying 12 times earnings, 10 times earnings, 8 times earnings. So this would have been a great time to buy it in 2011. You're only paying 8.6 times earnings. So that means 8 years of earnings you're paying in order to buy Coca-Cola. Now, fast forwarding to 2023, you're paying 25 times earnings. At one point, it was almost 30 times earnings. So that's 30 years worth of earnings in order to buy Coca-Cola. So you can see the stock price has gone from $16 up to $60. So a ton of stock price appreciation. And the multiple is appreciated though a ton too. 8 to 25, 8, 16, 24. And that's like 6 times appreciation in multiple. So the actual earnings per share, if you look at this middle chart, it's kind of flat. I'm not going to lie. Earnings has not been going up much. It's gone up a little bit, $1.52 per share to $2.40 per share. But the price has appreciated way more than earnings has appreciated. So these multiples really help you understand. I think that Coca-Cola, it's not something I would buy now. I think that the price to earnings is much higher than I would be comfortable paying for it. If it went back down to 12 or something, I'd love to buy Coca-Cola. That's great. They have a high dividend. That would be a reasonable price. Coca-Cola is definitely going to be around for my grandkids and great grandkids. It's not going anywhere. But 25 times earnings, that's a bit more than I want to pay right now, especially when I can buy Tesla for 50 times earnings when they're growing 50% a year. I kind of want to show you. Let's look at sales first. So price to sales ratio. Wow, this has expanded a ton too. They were like 2 times sales, 2.5 times sales, 3 times sales in 2014. Now you're paying 6 times sales. So almost double, almost triple, not double the price to sales ratio. So we're seeing multiple expansion in all of these areas. So stocks can appreciate by their multiples expanding, but the only surefire way, you can't predict, oh, this company's multiple is going to expand. The market's going to start valuing it way more based on the same sales. You cannot predict that. But what you can predict is that the actual sales are going to be increasing. So that, like, say you thought that Coca-Cola's actual sales were going to triple. Well, then you might be like, yeah, buying it for 2.4 times sales is great because their sales are going to triple. So the stock's going to triple on the same ratio. But if the sales tripled and the ratio tripled, well, then you're getting a 6x. Hopefully that makes sense. But let me show you Tesla. We're going to look at Roku as well. But let me show you Tesla just so you can see like the difference here. Look at Tesla's revenue growth here. So going back to 2010, Tesla's revenue was like $21 million. Now we're up to $94 billion. That is crazy. And the amount of revenue growth every year, I mean, this is just like a straight line up. This is insane. So paying a higher multiple for a company that's growing revenue this consistently, I think is a lot fairer than paying a high multiple for a company that's kind of stagnant on their revenue. But now let's look at Roku here. This is another company in my portfolio, but I just want to show you guys a different company to look at. So Roku has not been public for as long. So 2018 is the earliest that we can see here. But you can see they went public at 21 times book value. It was probably super overvalued. I'm not going to lie. It went up to 35 times book value. Now, this is just one of 3 ratios, but 35 times book value. And it's averaged, pretty high, 20, 10, over 10 for sure. It went up to 32 again. But look at this. It's now collapsed. And it's trading for 4.5 times book value now. It was all the way down at the end of last year, December of last year. It was selling for 2 times book value. But that's just one of the ratios we can look at. Let's look at price to earnings next. Okay, so this is interesting because Roku is not yet a profitable company. So you cannot always get the price to earnings ratio of companies because especially new companies, if they are pre-profit, because they're still growing, that means they're investing all their revenue into future growth, they're not going to have claim to profit yet. Tesla was a company like this for a long time. Tesla didn't make any profit, but they were still growing a ton and they had a clear path to profitability. And this is where doing research, understanding how do you get to profitability is really important. So their PE shows at 0. There was a short time during COVID where just so many people were watching TV that they actually did start getting an earnings. They had like $2 of earnings per share or something. And at that point, they were trading 133 times earnings, which sounds crazy because they were just hitting profitability. The earnings multiple can seem super out of whack if a company's just getting to profitability, because there's a lot of profit growth ahead if you're just hitting profitability. As long as the fundamentals make sense. A lot of people think that buying unprofitable companies is more complex. I don't think it actually is that much more complex. Almost all of the companies I own besides Tesla are still pre-profit. And I just feel super comfortable buying pre-profit companies when I understand how they're going to get to profitability. But you have to have that understanding. You need to understand, okay, this is how next year they're going to start being profitable for the first time. Because normally what happens, because the stock market does not like buying companies that lose money, as soon as a company hits profitability, the stock price just skyrockets. So those are what I want to kind of be a part of. I want to get that massive skyrocketing, but that's just one kind of investment strategy. There's plenty of other investment strategies that can help you make money, but understanding these basics is going to allow you to come up with your own strategy that you really like. And I also highly recommend reading books like Peter Lynch and stuff like that. So their price to earnings ratio has been 0. It's kind of hard to really value the company based off of this. So we have to look at price to sales ratio. And this is where I found a great deal, or felt like I was finding some great deals in Roku. So when they went public, it was, they quickly shot up to 6.6 times sales, and it was just up from there, really. I mean, they fell to 4.3 times sales, 10, 11, 13 times sales. At the peak, they were definitely overvalued. I mean, the stock price itself went from $30 to $459. I think it had some intradays where it crossed $500, which was crazy. And that was all multiple expansion, or almost all multiple expansion. 26 times sales is very expensive. Remember, Peter Lynch says if a company is growing 26% a year, their earnings, paying 26 times earnings is fair. 26 times sales, that's top line revenue. Who knows how much has any chance of dropping to earnings? So that's crazy to pay 26 times earnings. But now, after the Fed started raising interest rates, we had growth companies absolutely collapse. I believe Roku fell like 90%, over 90%, from almost $500 to $40. The price to earnings ratio, this is what, remember I said the stock market can be manic depressive? The stock market 1 year was willing to pay 27 times sales almost. The stock market the next year was not even willing to pay 2 times sales. That's crazy, guys. That is crazy. So 1.79 times sales. And I've been buying up a ton of Roku around this level. And you can see the stock price has almost doubled actually from the bottom. But if you count it from the top at $500 to 80, it's still down a ton, over 80%. So that's just an example, kind of looking at these 3 indicators of value that you can look at here. So let's move on now to step 3. This is the final step here. We're getting to the end of this video. Congratulations to everyone who's been watching through. All right, step 3. Hold and let time reward you. So very, very simple, guys. Step 1, research businesses. Step 2, buy at fair prices. Step 3, hold and let time reward you. It's that simple. 1, 2, 3. Research, buy at good prices, hold, and let time reward you. All right, so there's some great quotes to read here. All there is to investing is picking good stocks at good times and staying with them as long as they remain good companies. And when he says good times, Warren Buffett actually means bad times. Like when it's a good time, as in the market is giving you a ridiculously good price. It could mean that it's kind of a bad time for that company, but it's a good time to be buying that company. Because oftentimes the fundamentals could still be good and the stock price could be getting punished a ton, which is where you get that multiple compression. All right. So all there is to investing is picking good stocks. So that means doing your research at good times, means buying at a good value and staying with them long. Warren Buffett's giving the same 3 steps that I'm giving here. This advice isn't coming from me. It's coming from the best investors. All right. Quote number 2, also from Warren Buffett. Calling someone who trades actively in the market an investor is like calling someone who repeatedly engages in one night stands a romantic. The stock market is designed to transfer money from the active to the patient. Our favorite holding period is forever. Warren Buffett. Now, obviously, Warren Buffett is an extreme investor, but really that's what you should be shooting for. Buying companies that you're willing to hold forever. All right, now some a Peter Lynch quote here. The stock market has been the best place to be over the last 10 years, 30 years, 100 years. But if you need money in the next 1 or 2 years, you shouldn't be buying stocks. And this should seem obvious to you now after everything that we've gone through, because the stock market can be manic depressive. Stocks go down. If you need the money in 1 year, don't buy stocks. You have no idea where a stock's going to be valued 1 year from now. However, over 10 years, over 30 years, over 100 years, the stock market has been the best place to be. And then finally, a quote from Howard Marks here. Return alone, especially return over short periods of time, says very little about the quality of investment decisions. So you need to let time play out. You could buy a terrible stock that's on its way to going bankrupt, and the stock could double. And you could be like, that was such a good investment. It wasn't. The stock's going bankrupt. You better sell out of it. And that's why Howard Marks says that returns over a short period of time say very little about the quality of an investment. So hold and let time reward you. Time is your friend in the stock market. Warren Buffett calls compounding the eighth wonder of the world. So example. This is an example of time being able to just super reward you. In 2022, Berkshire received $704 million in dividend income from Coca-Cola. That's a lot of money. Almost $1 billion in just dividends. On an original investment of $1.3 billion. That amounted to a yearly return of 54%. That's 54% returns annually in dividends alone. This is money literally getting paid to you for holding a stock. We're not going to get into dividends in this video, but just know that once companies start becoming super profitable, they can choose to pay out some of that profit to the actual shareholders in a dividend per share. Personally, I think like even a company like Tesla might start paying a dividend eventually, but definitely not while Elon is CEO. That return is so high because Berkshire bought most of its Coca-Cola shares in 1988 and 1988 and 1989. Beginning the purchases soon after the 1987 stock market crash. Who was buying in the crash? Warren Buffett was buying in the crash because that's when he saw all of the deals. So holding over the long period of time can just really be rewarding. Now remember, he was buying in 1988 and these returns are happening in 2022. That is 40 something years later. Hold for the long term. It can be super, super rewarding. Okay. So now let's just in the last section here, before we end out this video, some common questions that you might have after watching all of this. One is, how do I find great companies? 2 is, when do I sell? And 3 is, should I be diversified? So let's quickly go over these. How do I find great companies? So the retail investor, and I highly recommend reading some Peter Lynch books because he really helps you understand how to find great companies. But the retail investor has an advantage. You as an average person have an advantage. We are on the ground buying products daily. You might go through Dutch Bros. You might be like, this is some great coffee. This is always super busy. Wow, they only have 600 stores. They're trying to get to 4,000 stores. Maybe Dutch Bros is a good investment. And I don't know. I haven't done that much research into Dutch Bros, but it is something that's piqued my interest that I'm going to be researching soon. But I'm just saying, like, that's how you have an advantage. You're buying products. You're like, man, these people make really great jeans. These are way better than any other jeans I've ever had. Like, that could be a little tip for you. Peter Lynch's approach is strictly bottom up, with selection from among companies with which investors are familiar. So first, companies you're familiar with. What are companies you like? Then through fundamental analysis that emphasizes a thorough understanding of the company. So after you're like, oh, this is a company I like me, I'm like, I like Dutch Bros. Then I do a fundamental breakdown. What are the fundamentals? What's the revenue like? What's the debt like? What is the growth rate like? What are the fundamentals of this company? Really understand those. What are its prospects? It thinks it can get to 4,000 stores. Huh, that's pretty impressive. That's pretty interesting. Is that reasonable? Well, yeah, just look how many stores Starbucks has. Look how busy every store Dutch Bros already has open. Look how busy they all are. It's a competitive environment. And whether the stock can be purchased at a reasonable price. So these are all things to look at. So you start with companies that you're familiar with. So how do I get ideas from where I look for my stocks? Well, one is just in my everyday life. Two is YouTubers and articles. I watch so many of financial YouTubers and stuff, and I do not blindly follow what they say, trust me. But if there's something that they're really excited about, I'll take that as a tip, and I'll do my own research based off of that tip. Or I'm reading articles, and people are writing articles about a company. That might be a great place to find a tip. And then I try the product. Does this actually taste good? And it can help me start my research. Open source analysis from hedge funds or investment managers like ARK Invest. Great place to get your tips to just know where to look. You could even look like active portfolios like ARK. They release all of their holdings. And you can say, okay, let's research their number one holding. Let's research the number two holding. Let's research the number three holding. And if one really makes sense to you, you're like, oh, that product is really great. Then that can be a great way to start researching that company. So just going over the top 4 positions in my portfolio. My number 1 position is Tesla. I first heard about Tesla on YouTube. I was watching some YouTubers literally make videos about their Tesla and how awesome their Teslas were. Then I found some YouTubers talking about investing in Tesla and how they thought Tesla was a great investment. Then I bought my own Tesla and I was like, this is incredible. This is so much better than any other car that's ever been made. This is an actual computer on wheels. And that is how I started. Now, after that, obviously, I needed to do my fundamental analysis. I needed to understand the company's like actual revenue, their growth prospects, their competition, all of that. But it started with YouTube and personal experience. Roku, my number 2 holding right now. Personal experience. I've used Roku. My parents use Roku. In Canada, my uncles were using Roku. I was like, man, there's a lot of people using Roku. I wonder if this is a company I could buy. And then after doing some research, I found out that ARK Invest had a whole valuation analysis on Roku that blew my mind. ARK Invest's research on Roku was mind blowing. I was like, holy crap, this company is so undervalued. They're going to be making so much money. But it started with personal experience. Number 3, Square. It's called Block now, but their ticker is still SQ. I started getting tipped off about Square from the App Store, where Cash App, it's an app that they made. Cash App has been number 1 free finance app on my Android for like a year or 2 years. And I was like, man, this app is always number 1. It's always ahead of PayPal. It's always ahead of Venmo. It's always ahead of all these other apps that are like really big. Like, I wonder if this company is making money from this app. And then once again, I found ARK did research on it. I found some YouTubers talking about it. I started doing my own fundamental analysis, but it started from literally just seeing that it was number 1 in the Apple store and in the Android store for over a year. And it had great reviews. And then I sent money to my friends with it and got money back. And then I invested in some stocks. I bought some Bitcoin through Cash App. And I was like, this is a great app. And that's how my analysis started. So that's how I got tipped off on this great company. Now, there are going to be times when you find a company, like you like a product, you do research and you're like, oh, this is way too overvalued, or, oh, this company actually doesn't have the type of growth that I want. Like, let me give you an example. Air fryers got really popular. I started, my brother bought an air fryer and I was like, I want to see, man, air fryers are getting big. Let me see if there's any companies. And there was a company I looked at and it was like, man, this company has so much debt. There's no way I could buy this. And then guess what? That company went bankrupt as soon as the air fryer craze kind of went away. So just because you like a product doesn't mean it's a good investment, but it can be a great way to like tip yourself off to research that company. Number 4, Avant Brands. This is actually a medical cannabis company in Canada. But I was watching some YouTube videos about the cannabis space, and some YouTubers were like really positive on the CEO of this company. So then I looked up some interviews of the CEO of the company, and then I was like, well, what's their product like? The CEO seems to say their product's the best. Let me see if it actually is. So I went on Reddit. And I found out Reddit actually thought that this product was the best. I watched YouTube reviews, and the YouTube reviews of the product were just like way better than every other product that these YouTube channels were reviewing. And that's how I started my analysis. I was like, this might be a good brand to buy. Then I started looking at the fundamentals of the business. What's their revenue growth like? Now, Avant is a very small company. Avant is also not profitable. It's probably the most risky company I own, but it's one where I feel like their product is far above everyone else's. The CEO is someone I really like, and I think there's a lot of opportunity here for a ton of growth. But please do your own research, especially for this one. But yeah, that's how I find companies. It's everyday life, YouTubers and articles, and then open source analysis. And I just do research into companies that I'm interested in. Okay. When do I sell? We're almost done here, guys. Second to last question. When do I sell? So Warren Buffett would say never. Our favorite holding period is forever. Yes, Warren Buffett says. But answer 2 is probably the one you're looking for. So when a stock price outpaces a company's actual growth and another stock's price falls despite strong fundamentals, that is when you might sell. And you might not just like sell to get the money out. You're selling one company that's like super, maybe the market's like, you're like, this market, the market is saying this is worth way more than I think it actually is. And there might be another company where this company's worth way less. The market's saying it's worth way less than I think it actually is. Then you might want to rotate out of one stock into another. But do note that letting companies compound over a long period of time gives you tax-free compounding returns. Do research just into that. It is mind-blowing. Tax-free compounding is how billionaires are made. So maybe don't sell. If a company is a little bit overvalued, but you know that 10 years from now, they're going to be worth so much more, then it might not be worth selling and having to pay capital gains taxes on your profit and stuff like that. But let's look at what Peter Lynch says. Lynch is an advocate of maintaining a long-term commitment to the stock market. He does not favor market timing and indeed feels that it is impossible to time the market. But that doesn't necessarily mean investors should hold onto a single stock forever. Instead, Lynch says investors should review their holdings every few months, rechecking the company's story to see if anything has changed, either with the unfolding of the story or with the share price. So the company's story is like the reason you bought it. What are the fundamental reasons that you bought it? So with Dutch Bros, it might be like they have 600 stores now. They're going to get to 4,000 stores. Their sales per store are also growing. So like you recheck, is the story still good? Are they still opening more stores every month? Is demand still strong at all their stores? Okay, yep, it's still good. So there's no reason to sell even though the stock price is up. Or you might find out, oh, the story's actually changed. They stopped opening new stores. Sales are down at their current stores. Then that might be a reason to sell, but it's for fundamental reasons mostly. The key to knowing when to sell, he says, is knowing why you bought in the first place. This is it right here. When do I sell? Why did you buy in the first place? And has that reason changed? Lynch says investors should sell if, 1, the story is played out as expected, and this is reflected in the price. So maybe everything you thought was going to happen happened, and the stock market is now valuing the company based on that whole story playing out. And you're like, okay, it all happened like I thought. Now it might be a time to sell out. Or the price of a stalwart. A stalwart is a company that doesn't grow. Like a company might be making the same amount every year. It could still be a good investment. If a company is selling two times earnings and is not growing, you're like, man, in 2 years I make all my money back and then I just literally make 50% a year after that. It doesn't need to grow to be a good investment. But if a price of a stalwart goes up a ton, you might be like, okay, it's just super overvalued now because it's not going to grow. So that could be a reason to sell out. Or number 2, something in the story fails to unfold as expected, or the story changes or fundamentals deteriorate. So it completely plays out how you thought and there's no more price appreciation to get, or it completely fails to unfold like you thought and fundamentals are not going to improve and they're just getting worse. Those could be reasons to sell, Peter Lynch says. For Lynch, a price drop is an opportunity to buy more of a good prospect at cheaper prices. It is much harder, he says, to stick with a winning stock once the price goes up, particularly with fast growers, where the tendency is to sell too soon rather than too late. And guys, this is something I've seen so many people do with Tesla stock. You sell too fast. You sell too soon. When there's so much growth still ahead, don't do it. Rather than simply selling a stock, Lynch suggests rotation, or selling the company and replacing it with another company with a similar story but better prospects. Maybe it's more undervalued or something like that. The rotation approach maintains the investor's long-term commitment to the stock market and keeps the focus on fundamental value. Okay, and now this is the final slide that we're looking at here. Should I be diversified? This is a question, especially if you come from traditional finance and current portfolio management theory and all of that. You're going to think that diversification is really important. I don't actually think it is that important. Warren Buffett says the business schools reward difficult, complex behavior. I believe we had this quote before, but it's important here again. More than simple behavior, but simple behavior is more effective. Warren Buffett. And then Warren Buffett also says, why not invest your assets in the companies you really like? As Mae West said, too much of a good thing can be wonderful. Okay, so to really put this in, because I think Warren Buffett can put this into better words than I can, without a doubt. We are going to take a look at a video from Warren Buffett where he's talking about diversification. Because I just think this is one of the most powerful videos I have ever seen, and is really, really, really going to help you guys understand how I think.
So we have there's nothing
diversification, which is that diversification for its own sake is pretty pointless. So we're going to close out with Warren Buffett here. I think there's really no better way that we can end this video.
Nothing magic. We like to put a lot of money in things that we feel strongly about, and that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice. And
did you hear that, guys? To put money in number 30, like your 30 highest conviction, just to be more diversified instead of putting more money in your top conviction is madness. That's Warren Buffett saying that.
It may... if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own one stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love it, the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is you don't need it. I mean, if you have a really wonderful business is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition. And 3 of those will be better than 100 average businesses. And they'll be safer, incidentally. I mean, there is less risk in owning 3 easy-to-identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
So there you have it, guys. That was Stock Market Investing for Beginners, how an average person can become a stock market genius. I think there are so many nuggets of truth that I just shared in this video. Honestly, if all of it didn't sink in initially, save it to watch later, watch it again in a couple days, and the second time it's going to sink in even more. Even potentially think about taking notes. But this video, I think on its own, these truths, you might have to look a little bit deeper into some of these, like how to analyze a balance sheet. How do you actually do the fundamental research? Like some of this, you're going to find more information on this channel to help you even go deeper into. But this is a broad overview of 3 fundamental truths, 3 simple steps that will help any average person, I think, make tons of wealth in the stock market. So if you enjoyed this video, if you appreciated me putting the work into it and spending an hour and a half recording this video, then I would super appreciate you guys dropping a big thumbs up. I'm not asking for Patreon supporters or donations or anything. I literally just did this to try and help you guys make more money in the stock market. So a subscribe and a thumbs up would be super appreciated. Yeah, that's it. Go make money, guys. Go invest, go research, read books. I highly recommend looking for books from Peter Lynch, Warren Buffett, Benjamin Graham, Mark Howard's. Reading books is gonna give you far more depth than this video did, because it's just an overview and it's taking a look at a lot of their fundamental truths. But reading books is super valuable. And until next time, everyone, have fun investing. I think this is a fun thing to do. Be safe and go make a lot of money, but not in the short term. Make a lot of money over the next few decades. Till next time, everyone. See ya.